So the ISM, the next chart versus the NASDAQ. The year-on-year NASDAQ is pricing in the ISM at about 41, which is almost pricing in the full sharp 1970s recession. So it's already priced it in, or close to it. Maybe there's another leg lower. The S&P in this terms would be somewhere like about 45, 46, so pricing in a recession. Discretionary stocks, consumer discretionaries, are the same as the NASDAQ, pricing in a full recession. The growth end of tech, the really growthy stuff, that's at 39. So that's really pricing in a full recession. There is a lot going on and it's very noisy for a lot of people. So I'll see if I can distill my thoughts down. It really is a follow-on for the last piece I did on Real Vision on the platform and explained to people my macro view, which was that we were very likely to be going into recession. It was likely to upset markets for a period of time. And there were certain markers I was looking for that would usher into the next phase. So I'm going to walk you through in a bit more detail now where we are now. So the first chart that I want to show is the Financial Conditions Index, which is basically a combination of commodity prices, the rate of change of rates, and the rate of change of the dollar. That against the ISM, which is the Purchasing Managers Survey, which is a good guide to the business cycle, is a 9-month lead. It's one of the best indicators we've got. And what it shows is financial conditions tightened by the fastest rate in history. And that is leading us to expect that the economy is going to have a Wile E. Coyote moment where the ISM goes from 53 down to, let's say, 35. 35 is a severe, sharp recession. Now, that indicator is already bouncing as bond yields are starting to come off, and I'll come on to this a bit in a minute, and oil's come off a little bit. And it's kind of suggests we're going to see a sharp recession. Now, last time I spoke about previous recessions and times that have looked similar. The one I've been following the most is 1973, 1974, where we had the Arab oil embargo. That was a supply shock. And what happened was the price of oil screamed higher, the economy collapsed, and the markets collapsed. And in that last phase, roughly where we are now, it actually went from 56 in the ISM to 30 in 4 months. It was the fastest collapse in history of the ISM. And that was caused by the supply shock in oil. And I think we got a similar setup. We also had something very similar after World War II, 1947. We had, like COVID, the whole world had been shut down. You reopen it, not enough supply of stuff, everybody's back into the civilian labor force, and the price of goods explodes. Inflation goes up to 20%. 2 years later, and economic growth collapses, the ISM goes down to 30, similar kind of setup, and the equity market collapses with it. The other one was 2018. We also saw a rise in commodity prices. We also saw financial conditions tightening massively because the Fed had been tightening and quantitative tightening had been going on, and the ISM again collapsed. So, and the equity market went down with it. The Fed pivoted. In all circumstances, the Fed actually changed very fast. They didn't change when inflation rolled over, which is the narrative. They have to see inflation roll over. It actually changes when the ISM crosses 50. I went back and looked at every single time since 1967 that the ISM crosses 50, and the Fed cut every single one except 2016, where they paused. So it tells you that the economy takes over all precedent when it comes to the things they monitor, because then unemployment becomes more important, because unemployment means voters and other stuff, even recession. So, okay, so where are the markets, where are we pricing in other stuff? So that's 9-month lead. So the next chart to bring up is the ISM new orders less inventories. That's a 3-month lead, and that suggests the ISM in the next 3 months is going to 45, which is a full recession. So it's saying we'll be in a full recession within 3 months. Okay, that's starting to get interesting for us. Now, the issue here is inventories. So the next chart is the chart of wholesale inventories of durable goods. I mean, that chart is shocking. And there's different types of inventories, and most of them show something similar, is that inventories have gone up because everybody stocked because of the supply issue. They overstocked and now demand has gone. Demand has gone because the financial conditions have tightened, and inflation has taken away discretionary spending. So now everybody's got too much stock. Now, building of inventories is positive for GDP in the equation for GDP, and releasing inventories is negative. Normally, to get rid of inventories, you lower prices too. So that starts to get interesting to say, if they're going to have to clear all this inventory, they're probably going to have to lower prices. So that's the next big debate, inflation. The next part of this equation, I've laid out what I think is demand destruction writ large, and it's already in the data. So then what does that mean for CPI? So if we use the same inventories to new orders ratio, which is the next chart, this leads CPI. Now CPI, if you can see on this, is crazily elevated. Now that's because of the Russia situation and some of the supply situation, but it's also not unprecedented. Yes, the level is high, but if you peek on that chart back at 2008, what we had was inventory to sales got to zero and crossed it, but meanwhile we had this peak in CPI still. Now the Fed were cutting through that, by the way, and they did it in other periods too, similar. But that period is telling us again, 6 months lead time, that CPI should fall dramatically. Now, if I go on to the next chart here, it's the chart of commodities. Remember when Peter Zeihan came on and shocked us all to say we're going through a world food shortage? Well, most of the food prices for Western economies have actually collapsed. So the commodity complex overall is down between 20 and 60%. So this is the all commodities year-on-year rate of change. Now, considering oil hasn't gone down a lot, it's only pricing in a ISM of about 54. The actual inflation from commodities has evaporated. And the longer it goes on, even if prices stay the same, the more this will go to negative year-on-year. So the inflationary effects of the commodity prices, the supply crisis of all of these commodities, agricultural, energy, they're all going out of the numbers super fast. So I think we're teeing ourselves up for a situation where the narrative shifts from inflation and growth is bad to, okay, inflation's coming off, but growth is much worse than we expected. So what does that mean for markets? So if I look at the next chart, it's actually, I mean, I love the ISM, the business cycle. I don't know why more people don't use this stuff. So the ISM, the next chart versus the NASDAQ. The year-on-year NASDAQ is pricing in the ISM at about 41,